but does it fit into their overall goal, being government-owned entity? If you ask RBS's own example, when the crisis hit the bank and the bank had to seek external capital, of course, every other bank was seeking capital at that time, and you had only two options. Either you could go to the Arabs or you could go to your own government. So Barclays chose to go to the Arabs, and let's say RBS chose to go to the government. And we saw, once the government comes in, right, there are a lot of questions to answer for the government, not for the bank necessarily. The government needs to justify the kind of investment which is going into a bank, which is not just taking care of its own economy. It's not an UK economy alone, right, which is going to get benefit out of a UK investment. So it's the global presence of the bank which benefits. Even the RBS India operations also get benefited out of Her Majesty's Treasury investing in the bank. So the question is, are banks now willing to look at more and more expansion, or are they better served by catering their own core markets? That's one very important question, and that's all the more important when government has invested in you. So the public sector banks will be very cautious in looking at any large transactions.
Thank you, Gurudas. This question is on relating to project finance. As he pointed out, the demand for infrastructure finance is going through the roof, in the sense that we need to invest something like 100 trillion, which is substantial for the system. So what he was pointing out is that the banks will sort of lose steam sooner or later. So my question is, are Indian companies thinking about project finance bonds, bond issuance outside India, or syndications, or use of multilateral agencies and so on?
I think Indian companies do look at sourcing finance from outside. I think a lot of activities are happening in ECB market, probably which reflects even infrastructure projects. If you talk to any company today, they say they want money from ECB market. One is today they feel that it's a little cheaper vis-a-vis rupee loan, but also there are restrictions in terms of the amount of money that can be raised in Indian market. So in terms of international capital market, probably I think it will take some time. As of now, I don't see much of activities in that area. Probably they have to source that to meet the requirements here.
Thank you. This is on wealth management. I just wanted to know your own perspectives on how the industry is likely to evolve, possible size, consolidation and so on.
See, in terms of domestic companies, some of the broking companies also used to do this wealth management, and today it so happens that the wealth management business is actually more profitable than the broking business itself. The institutional broking business has become very, very competitive. Yes, I think wealth management or private banking, whatever you call it, is fairly new to India. We are just about 10 years in the infancy. You will not find people with a lot of experience. So it's an industry which is evolving. Globally, yes, it's one of the most profitable businesses for most of the banks. So I'm sure in India also it is evolving, one. And two, people are willing today to pay for the advice what they get, which it was not some couple of years back. A few years back, most of the people who had money were all the industrial houses, and most of the industrial houses would have their Muninjis who would take care of their accounts, and they would decide what their bosses want. But today it is different. It's a lot of professionals who have made money like because of the ESOPs. Some people have sold their companies and made money which they never thought they would make. So all these people certainly value and need advice, and those kind of investors are actually increasing, and with this probably I think we are just scratching the bottom of the industry in India. I think it's got to go a long way, but I'm sure we have constraints in terms of experienced people. So once I think the industry evolves, we should be able to get experienced people, and then should be able to grow further.
Mr. Abhay, what's your take on the future of the Indian debt market, in the sense that since you have been raising capital for his bank, it's a known fact that the Indian debt market seems to be, very shallow. As he was pointing out, the stock market itself is shallow and debt is even more shallow. So they used to say, in the late 90s, that the Indian debt market is not a market, it is a club. Meaning that some 10 people transact over the telephone, so there is no market. So,
yeah, I totally agree. The Indian debt market, if you're talking about a corporate bond market, it is extremely shallow in terms of products available. For it, I will try to give an example of a bank. In our case, we do that job for our own bank. The capital is subscribed to by effectively three investor classes, primarily by other banks, where it ends up being informally a bit of an I scratch your back, you scratch my back arrangement. Secondly, it is subscribed to, the main subscriber that we look forward to is the insurance segment, where LIC on its own is able to support maybe 30% of the balance sheet requirements or debt capital requirements of most banks on its own, because of a severely huge appetite. Thirdly, you have provident funds kind of investors who have in their own capacity contributed heavily to capital basis. This works for most asset classes or most issuers of long-term debt. On the short-term side, the situation is slightly different. If you're talking about short-term debt of less than 1 year, which is raised by banks in the form of CDs or by corporates in the form of CPs, you have many more subscribers, largely because mutual funds come into the picture. And there are several other investors also who come into the picture. But while we are talking about debt, it would effectively mean long-term debt. So for long-term debt, these investor classes, as of now, are restricted to do these two or three that I mentioned. Insurance is one place where we have we have unfortunately low investments, largely because India itself is not adequately insured. As the insurance business triples and quadruples, then we will have many more investments or a much larger chunk of investments coming from this class. Secondly, pension funds are just starting off. That is again internationally a big investor class, which we hope would add to our investor base in the coming years. International investors, obviously, their entry or their investing ability is restricted by regulators as to, and I don't think that will change too much in the coming years at least. Retail investors for debt capital has been tapped on by some institutions and some corporates. We had a spate of NBFCs hitting the retail investor market recently with Manappuram, Muthoot, Religare, all these NBFCs hitting the debt capital markets for subscription. They got a good response. In the past, when they were unfortunately not helped with market not being at its best this time around, A couple of years ago, I remember another spate of NBFCs hitting the markets was with Shriram Transport Finance or LT Finance. These guys hitting the market, they got good subscription to their issuances. So investors are probably waking up. They are probably starting to look at a 10-year investment horizon in a corporate, not so adversely as compared to a bank investment. In form of a long-term FD, because that is really what you are comparing it with. If I'm looking at a 10-year investment horizon as a retail investor, what do I have to compare it with? I either buy land or property or equity. Equity typically, I don't know how many people actually invest with a 10-year horizon, or I am left with corporate debt. So in that case, I think people are slowly moving towards looking at it a little more favorably. Once this improves, once this increases, along with these other changes that I feel should be happening by way of insurance companies, insurance investments going up, pension fund investment going up, and I think we should have good times ahead for debt market in India. That will still be limited to the number of products that are available, which itself is very scarce and far behind what is available internationally. But still, it will be at least an organic way of accumulating capital.
Thank you. Thank you. So with that, we now leave the floor open for questions. We'll take questions from the audience. You can ask any of the speakers. We have about 15-20 minutes for the question and answer session.
My question is to the whole panel. Will Indian financial services sector be so huge that it will start threatening the economy in next decade? I mean, like in US, will it ever go to that stage, or India is too different to attain such a stage?
Okay, I'd like to respond. This is, in other words, this is what he said, namely that the regulator will not allow them to go big. You get what I'm saying? So the financial services industry will probably not be allowed to grow to such an extent that it will threaten the entire economy, because as you were saying, just setting up a company takes something like 2.5 years. Not to talk of many other regulatory and other types of hurdles. So this is precisely for this reason that probably that the Indian industry has not been as much affected by some of the other European and US, in the sense that there is no risk and hence no reward also. So this is one view that I have.
If I may just add to Vishwanath's point, there's a very valid point about regulators not letting the banks do what they would probably would like to do. Is also the fact that currently the debt as a percentage of GDP on that parameter, India is quite low. Probably it's 1/5 of where US is, or most of the Western European markets are. So debt as a percentage of GDP is what the real killer is. So I guess unless all of us believe in very highly leveraged kind of lifestyle of earning 1 lakh and wanting to own a house in Mumbai, I guess the country is safe that way.
I'll just like to add, as in that's the core point which Gurudas mentioned, as in debt as a percentage of GDP. As in just as an aside, if you look at the size of the markets as such, as in we talk about the size and scope for growth for the Indian financial services. Let's start with equities. If you take the market cap of all the companies listed on either BSE or NSE, it's equivalent to the GDP of our country. So it's around 1.5, 1.6 trillion USD. Now that's as far as the equities are concerned. Now you come to say mutual funds. So currently we manage say around 7 lakh crores of assets in our country across say 42 fund houses. So if you put together the size of the industry per se and compare this, and you add the other instruments too, I've just given a flavor. if you just put all these together and look at the size of the industry and look at what fraction of it is it as part of a GDP vis-a-vis and benchmark it, say to the US or UK, we have I think we have a long way to go. So in terms of the risk over and above what Gurudas mentioned, as it becoming so huge and so leveraged that it gets beyond control, wherein it just pulls the entire economy down. As in, I personally believe that obviously we are interconnected, as in there will be domino effect on what's happening in the global world. But if you look at Indian market and the size of the overall market and look at each of the segments, be it equities, derivatives, anything, any other financial instrument. So as in we still far away when we compare it to where the US was in 2008 and where the European economies are in 2011.
To add to what he said, I was in the United States about a week back. There was a front page article which mentioned that Americans had accumulated $20 billion more of credit card debt. So the article speculated, what would the outcome be if Americans went on a borrowing binge. So it said that, they need credit counseling badly, and if something is not done, probably it will get out of control. So, but I don't think that would be the case with India, in the sense that the credit line available from credit cards or other traditional sources itself is very low compared to what you can borrow with a credit card in the United States. So to that extent, we are safe.
So I had a question for panel. When we talk about FCPA US Act, which is recently in 2010 it was passed on, and UK Bribery Act. So after that, it's not only stipulated to US or any particular country. Even if the corruption occurs for any foreign investors, say in India, India is actually perceived based on the CPI index as very highly corrupt country as such, and because of the politicians being the corrupt leaders, the foreign investment in India will be less. So what is your view on that? Means there are these two things which are contradictory. FCPA will have a check on investors who, and also they have their corruption. If the foreign government officials are involved in that company, then investment will be under check for the foreign companies. So what is your view on that particular point? When we talk about FCPA, the Foreign Corrupt Practices Act, what FCPA tries to say is that if at all some political leaders or any corruption incident is associated with a company or a country particularly, then you will also face the consequences if you are investing in that corporate, in that company or country probably. So because of that, foreign investment will reduce. That's what I perceive it as. What is your view on that?
See, I think as I said in the morning, foreign investments chase returns. So whichever country, whichever place gives them a better return, the money flows, irrespective of all the bottlenecks that are there. So I think to that extent, I would not agree that because of these restrictions, the money flow would stop. The only thing I would say is the money flow would taper down or reduce if there is a perception that that country is not attractive. So the foreign money doesn't invest because it is a India or a Brazil or something. As long as returns are there from that particular country, the money comes. If there is no return, it is taken out immediately, and then the money goes back as fast as it comes in. So I feel there should not be many concern on that.
Yeah, if I may just add to that, frankly, the UK Bribery Act, of course, it's perceived to be a lot more stringent than the FCP that you mentioned. But how much of investment does come from UK into India? I mean, not much, right? And whatever comes probably is already from very highly compliant kind of companies. So the percentage of impact that it might have would be very limited. But probably the FCP part is a little more significant, as in because it's the US investment into India is still reasonably significant. I guess it'll have some impact on the manufacturing side and maybe on the infrastructure side as well, because what we understand is that the expectation of the Indian administration or political system is only increasing. This is the informal language used for the bad word. I guess people will find newer ways of managing that. It's not that even Indian companies are not facing that challenge within India, doing business in India. People have continued to do business and survived. So Americans are good at it.